In functional analysis, an important aspect, selection of most appropriate method with case studies. For this topic, we have BharathLakshmi Narayana, who is a very eminent speaker. I request. I request the chairman of Bangalore branch to escort the speaker onto the dais. I request the chairman to present him a floral bouquet. Welcome, sir. I take a privilege in introducing BharathLakshmi Narayana, who is associated with SDU, Bangalore. He has over 16 years of experience in field of taxation. He focuses on advising clients on Indian domestic tax and cross-border tax issues, tax optimization strategies, transfer pricing and exchange control matters. He also regularly attends the matters involving representation before the tax authorities and the income tax appellate tribunal. He is also presently a co-convener of the Bangalore Study Group of the Chamber of Tax Consultants, Mumbai. He has spoken at Bangalore Study Circle at ICI on income tax, transfer pricing and exchange control topics. With this brief introduction, I present to you all BharathLakshmi Narayana. Over to you, sir.
Thank you, Pramod, for the kind words. Good afternoon, all. Thank you, Chairman, for welcoming me very well in the institute this morning. Good afternoon, all of you. So, I think we are in the thick of the transfer pricing season now, and I think this would be the best time again to know some more sharper dimensions of transfer pricing. And I think this morning Narendra Jain would have given you a quick but deep introduction into this concept of transfer pricing and how we go about transfer pricing certification and documentation at a very high level, so to say. And in the next 90 minutes, we just spend some time with two core concepts of transfer pricing, which are arguably the soul of transfer pricing. The first being the functional analysis, and thereafter the methods of transfer pricing and how to apply the method to determine the arm's length price. So just to give a quick backdrop and to take a few steps back, like you guys would have heard this morning, the whole purpose of transfer pricing law is to ensure that when there are associated enterprises and they enter into international transactions or what are called deemed international transactions, those transactions per se are in compliance with the arm's length principle, or that on account of those transactions there is no shifting of profits, there is no avoidance of tax outside India. And again, the transfer pricing, the concepts go back around 60 to 70 years in the international context, at least 60 to 70 years in the international context, and in India it's about 21 years old. And with increasing multinational activity in this country, transfer pricing has assumed a lot of significance for the Indian tax authorities, and ever since 2001 when the transfer pricing provisions were introduced, the government has been very intense on, rather the income tax department has been very intense on transfer pricing compliance and assessment thereof, and we see huge additions or very interesting disputes coming up between the taxpayers on the one side and tax authorities on the other. And like I said, the transfer pricing is all about identifying the arm's length price. And how do we go about doing it? Is the subject matter of our discussion today. In the next few hours, we'll be learning a little more. So, one of the stepping stones for a transfer pricing analysis is, of course, first we need to understand what is that transaction. What is the transaction whose arm's length price we are trying to determine, and how do we go about determining it? Alright? Functional analysis is a phrase which is used to describe a more detailed examination of that particular transaction itself. So let's take a simple case of a transaction of, say, a US company and its Indian subsidiary, right? Where the Indian subsidiary provides software development services to the US company. Right? So now the international transaction is provision of software development services to the US company. We have to identify the arm's length price of this particular transaction. So how do we go about doing this compliance? So now the rules say that first of all, to determine the arm's length price, you need to take certain steps, right? And that is where the first step of functional analysis comes in, right? So we now just see the rules on functional analysis, and which is prescribed in the income tax rules. And then we will go to some more practical dimensions as to how we actually walk down that road of conducting the functional analysis. Right? So, rule 10b2b, I have extracted the rules themselves because I would want all of you to familiarize yourself with the language of the rule. Right? And then we'll see how it is practically applied. Right, so we just go through that rule in the first part. Comparability of an international transaction or a specified domestic transaction with an uncontrolled transaction shall be judged with reference to. Right. So let's spend a little time with this phrase. Like again, I keep repeating this quite a few times. We are looking at an arm's length price. Now, what is the whole concept of an arm's length price? An arm's length price entails a transaction which an uncontrolled party would have entered into in uncontrolled circumstances. Right? So the example which I gave of an Indian company providing services to its parent company, both are related parties. Right? And the law presumes that in a related party transaction, there is going to be some avoidance of tax or shifting of tax. That's the presumption in law. And how do we rebut that presumption? We rebut that presumption by saying that that transaction was entered into in arm's length circumstances, or circumstances in which even third parties or unrelated parties would have entered into. So there is no difference between the transaction that I have entered into and the transaction which a third party would have entered into. Now, how do we get going there? Right? So what we need to do there is, first we need to understand what is our transaction, and then what is that unrelated transaction and how both of them are comparable. And then say that the margins or the results of both the transactions are similar and therefore I am at arm's length. So I compare my transaction or the related party transaction with an unrelated party transaction and conclude that since both of them have similar terms or earn margins similarly, the transaction is at arm's length. How do I go about doing that? That is where this rule comes in. Comparability of an international transaction with an uncontrolled transaction shall be judged with reference to. So you have an international transaction which is a related party transaction, and you have one more uncontrolled transaction. Alright? How do you judge these transactions? Alright? These transactions shall be judged with reference to the specific characteristics of the property transferred or services provided in either transaction. Right? Specific characteristics of the property transferred or services provided in either transaction. So in the example which we took, the Indian subsidiary is providing software development services to its group company. What are the specific characteristics of the property or services? So we need to understand in that software development transaction, what are the specific characteristics of that transaction? So what does that mean? That means we need to understand what is that software development services transaction itself. Right? All of us are familiar with what is, we've heard this phrase, software development services, IT enabled services, manufacturing of drug formulations, manufacturing of tablets, manufacturing of spare parts which are used in automobiles. Right? That is the name of the transaction, but what are its characteristics? Right? What are its characteristics? That is something which we need to understand a little more. That is the requirement in Rule 10. Alright, so just to take the same example of this software development services transaction, we need to ask these questions. Okay, what software are they developing? And in a software development, what are the typical stages of a software development activity? Right? And there, what is the role of the Indian entity? What is the role of the parent company? Let's take a more concrete example of, say, manufacture of spare parts which go into automobiles. Right? So, if the Indian company is supplying spare parts to its parent company who is engaged in the manufacture of automobiles, there, if we ask this question, what are the characteristics of this transaction? We have to examine a little further. What questions do we ask? The questions that we ask are, okay, so this Indian company is selling spare parts to its parent company. What does the parent company do? The parent company manufactures the entire car. Let's assume that the parent company manufactures the entire car. And entire car means the chassis or the engine, the various dimensions of the car, the internal components of the car. And within the engine, there are some components. Right? There could be some rocker arms or connecting rods, etc., which only is manufactured by the Indian entity. Okay, so the parent company manufactures the entire car. How it does that? Let's go to that a little later. It could have sourced the components from various vendors around the world, and it may assemble that at its premises in the US or somewhere. The Indian company's role is to supply only one small part in the car. Now the question is, there, to supply that part, alright, what all does the Indian activity do? Indian company do? So definitely with operations such as automobiles, there will be a set of standards saying that the parent company would say, you have to source this raw material from this particular vendor in this country. Right? And this is the process of making that connecting rod or rocker arm. Right? And for this you need to purchase these machines. Right? You need to set up these machines in this particular manner. To run this machine, there will be so many people who you have to hire or engage. And then once you run the manufacturing process, you will have an output. This output, you will pack it in a particular manner and send it to me in a particular manner. Alright? You will, for that, for manufacturing these products, initially I will fund you with equity share capital. Alright? But after that, you raise an advance invoice against me and I will send you an advance. With that, you incur expenses to purchase raw materials, to employ people. Right? So that's how we're delving a little deep into the characteristics of the property or of the property transferred or services provided. So in this case, I gave an example of connecting arms or connecting rods or rocker arms for an automobile sector. Similarly, for software development services, let's just take a larger example. What is the parent company doing? So let's say the parent company is developing some accounting software. And in accounting software, all of us know it will have various modules. And the Indian company is developing one module of the many modules and giving it to the parent company. And there, the parent company will give specifications saying, look, this is the entire software package of which this is your contribution. Therefore, you need to give me ABCD, and the way to do ABCD is so and so, so and so, so and so. And to do ABCD, you will have to have software engineers who have ABCD skill sets. You engage them. This is typically the salaries which such people will earn. You give them those salaries, you have the work done from them. We will review the work which you do. If there are corrections, we will suggest that to you. And then you can with those corrections, you can send upload the software onto the cloud, and then we will integrate it. So this is the role of this software development activity which the Indian company is providing. So this is a degree of detailing that we have to go. Alright, the question is why? Why do we have to go into this country? Alright, that we will get to know as we move a little further. But this requirement, this first sub-bullet in 10b to b is this. This is the degree of detailing that we have to go to analyze each international transaction. And so, for example, let's take an international transaction which could be, say, sale of shares by a parent company to a subsidiary company. It would have, the subsidiary company would have bought the shares at say 100 rupees. It would have sold it to them at 300 rupees. Now, if we have to undertake this exercise of understanding the specific characteristics of the property transfer or services provided, how do we go about it in the context of shares? So there what we have to do is, okay, what are the shares which were being transferred? When did the subsidiary acquire it? Why did it acquire it? Why did the subsidiary company acquire those shares? Why did it hold it for whatever period of time? Why is it now transferring to the parent company? What is the value at which it is transferring? How is that value arrived at? Right? A simple transaction of sale of shares should require such deeper investigation from our side. And that is the important component of a functional analysis. Right? Why functional analysis? Why is that phrase used? Right? The answer to that is in the second subject. The functions performed taking into account assets employed or to be employed and the risks assumed by the parties to the transactions. So this is the second parameter with which we have to judge a related party transaction and an uncontrolled comparable transaction. What is this functions for? So the example of this, again, connecting rods and rocker rods. What are the functions performed by the Indian company on that manufacture? So we have to deep dive into the supply chain of that connecting rod and rocker rod. How is it done? How is the raw material procured? From which country does it come? If it is sourced from India, there will be a procurement team within the Indian company. How have they engaged with the parent company and how have they engaged with the vendor? So procurement is an important function. And then once the raw material comes, the raw material would have been stored by the Indian company at its premises. It would have incurred costs to store it. And thereafter comes production scheduling. Okay, so this Indian company will then say, okay, this is what we will manufacture over this period of time. Thereafter comes storage of that product and then finally dispatch of that product. Right? So that's the entire supply chain on the connecting rods or rocker rods in the manufacturing context. In the service context, how does this pan out? Right? So software development services. What are the functions performed? So who decides what software is to be developed? One of the first questions, who decides that? Parent company decides that. It gives that instruction to the subsidiary company. Right? It says I need A, B, C, D software and this is the broad manner in which you will do it. Right? So one of the most important parts of the strategy function, right, is performed by the parent company in this example and it is implemented by the Indian company. Similarly, if you take the manufacturing example, the parent company designs the strategy saying connecting rods and rocker arms I will source it from India, from this company. That is a strategy from the parent company that is executed by the Indian entity. Right? Thereafter comes, again, switching back to software development, the next point comes on the software development activity itself. So software development activity, that's typically, if we look up industry reports, say of the NASCOM, they say typically what is the software development life cycle. Alright, so it says the first step is the design. Alright, after design comes the coding, after that comes testing, after that comes implementation. Typically, at a very high level, this is a component of this is a software development framework. First starts with design, then comes coding, testing, implementation. Right? So in this accounting software example, if the Indian company were developing a component of the accounting software, this strategy of the activity of design, who is doing it? The activity could be done by the parent company wholly, it could be done by the Indian company partly, or the parent company could say, boss, this is my accounting software, this is the unit which I have to develop and put in. You decide how the software should look like. Therefore, here the Indian company itself could design that module altogether, or the parent company could design a part of it and the Indian company could design a part of it, or the parent company will say, look, this is the design. You please do the coding for this kind of a design. Right? So again, this is another function. Design is one function. Coding, who is doing it? India will typically do it, and that would be reviewed by the US team. Thereafter comes testing. So after the coding is done, whether the software is running in a manner it is envisaged is the other part. Lastly comes implementation. So implementation also India and US could jointly do. Right? So this is the next function of the delivery. The other part comes on marketing. Typically for commercial enterprise, marketing is an important dimension. In the software development transaction case, where is the marketing? India is not doing any marketing. It's finally getting used by the parent company, and parent company is doing the marketing for the accounting software or for the car. Right? So it's clear that marketing is an important function, but India is not doing anything. Right? And then comes the other functions of say administration, such as legal, accounting, HR. Who's driving those activities? Those activities are being driven under the larger strategy of the US company. India is only implementing. Right? So these are the various functions. So the most important part is understanding what are the functions for a particular transaction. So now if you were to apply the same logic to this transaction of sale of shares, you will not have it. Right? Here an example of manufacturing services. But for transaction of sale of shares, how can you do a functional analysis? Right? Therefore, with transactions such as sale of shares, the whole purpose of functional analysis is to get a more holistic and deeper understanding of the transaction. It need not be strategy, marketing, coding, execution, etc. So for the sale of shares transaction, a more rounded perspective of that sale of shares is what will constitute the functional analysis. The law unfortunately does not give us any guidance. It speaks of all of this at a principle level. Right? It does not say for sale of shares how you should do the functional analysis. For a manufacture of connecting rods or rocker arms or any other automotive component, it doesn't say how the functional analysis should be done. But we have to understand that in a particular activity, these are the many functions which are inherent in that activity and document it. Right? And why we have to document it, we go a little further. And again, the contractual terms, the third point, not taken the second point fully. Taking into account assets employed or to be employed. This is the other part. So typically this functions, assets and risks, they are called FAR. Right? The FAR analysis is what it is typically called in transfer pricing jargon. FAR, or many practitioners call it FRA, functions performed, risks assumed, assets employed. Right? Why is this relevant? Why is the point on assets employed relevant? Right? Let's take the same case of manufacturer of connecting rods or arms. What are the assets employed in manufacturing the components? There will be plant and machinery, there will be land and building. Land and building could be owned or could be rented out, leased out. Then comes plant and machinery, that also could be rented out or owned. Right? Then comes furniture and fixture, computers, and then to manufacture those components, assume for a moment it's a fairly complex component which is on which the parent company has a patent. Alright? If that is the case, the patent should have been shared by the parent company with the Indian company, and without that patent, without that manufacturing know-how, all of these assets are useless. Because without that know-how, this manufacturing cannot be done. Okay, let's take two scenarios. It can be done, it's a very generic product which does not require immense know-how. That's the first case. Second case, it is a very niche product which requires the know-how of the parent. In that context, let's look at this phrase, assets employed. First case, routine product. All the assets are owned by, let's assume everything is owned by the Indian entity and operated. We just document all of that. Alright? So if it's a routine product, the assets employed are also fairly routine. Alright? Again, this word routine is a very important concept in transfer pricing. Right? Because the premise is that for routine international transactions, the remuneration or compensation, etc., will be routine. For non-routine transactions, the remunerations will be non-routine. Right? So that is another dimension which we will have to understand at the first step. It's a specific characteristics of a transaction. So, is this a routine transaction or this is a non-routine transaction? Right? And typically, one rule of thumb is if the transaction is fairly run of the mill, it's seen fairly prevalent, seen to be prevalent in the market, then it is considered a routine transaction. Therefore, software development services typically will constitute routine transactions, at least in the Indian context, right? Because design, coding, testing, implementation is a fairly routine task in India. Right? On the other hand, let's say some R&D, research and development, on a particular software concept. Right? Let's say Tesla's driverless cars. Right? When Tesla's designed these automatic cars without a driver, that is a fairly non-routine activity. And if a person is, and if an entity is doing R&D on that component as to how to make cars driverless, that can be regarded as a non-routine activity. And the premise is non-routine activities require higher remunerations, so to say. And that's where the premium is attached. And coming back to assets and debt, we will list down if these are routine assets or non-routine assets. The second example of the technology being, the manufacturing process being very niche and requiring a know-how to manufacture, that would be a non-routine asset. Right? So you have your typical plant and machinery, land and building, but then that they themselves are not sufficient for the manufacturing process without that tech know-how from the parent company. Right? So how is the Indian company using it? The Indian company is using it as a licensee. The licensor is the parent company. India is the licensee for which it may pay some amount or it may not pay some amount. Right? That has to be documented. Alright? Therefore, now I will come to this point of why is this relevant. Now assume for a moment what we are manufacturing is something which is patented. Now how do we compare this manufacturing to another third party? Right? So when we do a check of comparables, we may find that these comparables are manufacturing routine products. Whereas myself, I am using a patented technology to manufacture a non-routine product. Now the question comes, can I compare myself as a non-routine manufacturer, non-routine product manufacturer with routine product manufacturers? Right? For example, a good case is in the context of pharma. Manufacturers of, say, paracetamol tablets. Those are fairly routine products because all the patents are of patent protection and the know-how for that is available on the internet with that. And paracetamol is a routine product compared to, say, a cancer tablet or a cancer injection. Alright? Both are medicines, no doubt. But are they comparable? So can you say that if a paracetamol manufacturer earns, say, 5% profit margins, even a cancer tablet manufacturer should earn the same margin? Prima facie, it doesn't sound right. Why? When we dig deep, these are the points which we highlight, saying that the cancer tablet manufacturer is manufacturing a non-routine product. He is using non-routine assets. Alright, he is performing non-routine functions. And therefore, comparing a cancer tablet manufacturer with a paracetamol tablet manufacturer may not be correct. So now what do we do? If there's a case where we have cancer tablets being manufactured, how do we get comparables? Right? That is where the functional analysis becomes extremely crucial. Right? Because with the functional analysis itself, we'll be able to determine whether what we are the transaction that we are talking about is indeed comparable to a third-party transaction. For all you know, it may be such a unique offering that you will not find comparables. If we are not able to find comparables, we have to tell that in our report, saying that these are unique transactions for which comparable information is not available in the public domain. Having said that, because we need to comply with the transfer pricing law, we have diluted our comparability measurements, and we are still taking, say, paracetamol manufacturers as comparables. Why? Because we are not getting any cancer tablet manufacturers, or we can say two comparables, whereas at least the law warrants some more comparables in that sense, one or two comparables. We can debate and argue on that, but then to give a comfort to the client also, we need to have a few comparables. But how do you compare a cancer tablet manufacturer with a paracetamol tablet manufacturer? You actually technically can't. But then, how do you complete the analysis? The view that we take is, in the absence of information on cancer tablet manufacturers, we are diluting the comparability criteria and say paracetamol tablet manufacturers are okay. In this context, what will happen also is, assume for a moment that the margins of paracetamol tablet manufacturers is 8%, right? And for cancer tablet manufacturers it is 18%. Right? 18% cancer tablets, 8% paracetamol. That gives one more reason for you to justify that this transaction is at arm's length, because typically a cancer tablet manufacturer is manufacturing non-routine products, and non-routine products typically warrant a higher remuneration. As a cancer tablet manufacturer, I have gotten that higher remuneration, and therefore I am at arm's length. Alright, with me? Let's take the same example of connecting rods in the context of automobiles, fairly routine products. Right, therefore, we get n number of automotive component manufacturers. Again, automotive components are of various types. Right? When we look at comparable information, they simply say we are engaged in manufacturing of automotive components. Bangalore, Pune, Gurgaon, they are all hubs of automotive manufacturing, particularly Gurgaon and Pune. And we find quite a few manufacturers of them, but then each of them has a particular niche. One may be a specialist in connecting rod, one may be a specialist in leaf springs. Right? So if you go to a leaf spring guy, he will say, boss, connecting rods and leaf springs are, you may call it automotive products, but then that's like saying, that's like comparing a manufacturer of plastic buckets, alright, plastic buckets, with a manufacturer of plastic components for a camera. Just because they use plastic does not mean they are comparable. Just because they use plastic, just because they convert raw plastic into a particular design, does not mean a plastic bucket manufacturer will be comparable to a, say, plastic used for these camera components or laptop components. Able to understand the difference? Right? That's why this concept of functions performed, assets employed. Now, what kind of assets do you use for a plastic bucket manufacturer? Connecting rods, rocker arms, fairly simpler routine products. The routine machines, routine equipment is used. But say for example, there are these 3D printers. 3D printing is still a novel concept in the world. Alright, and manufacturing a 3D printer requires extremely niche capabilities. Therefore, they may use steel components. So raw iron or raw steel components as in connecting rods may be used, that is fine. But then look at the output. That is equally important. Right? And that is where this concept of assets employed assumes significance. And lastly, risks assumed. What are the risks assumed with a particular product, a particular property or a service? How is this relevant? Let's take the case of the software development services example. The Indian company provides the services that is incorporated into that accounting software and it is sold. Alright, if something goes wrong with that product, who will bear the liability? Is the parent company? In that sense, the Indian company is insulated. Right? Therefore, the risk is assumed by the parent company on the product capabilities. Market risks, who bears? So, for a particular transaction, we need to look at many dimensions on this. The one of the most important is the market risk. Who bears the market risk? What do you mean by market risk? Market risk is you have the subsidiary company in India which has its infrastructure, people, etc. There is no market for the product in the US. So the parent company is facing a lot of it. Having said that, despite no business, assume that the parent company reimburses the Indian entity, say cost plus markup. Right? But the parent company itself is not making any money. So who's bearing the market risk there? It's the parent company. Because India is insulated from that market risk. Assume for a moment, the parent company says, no, I'm in deep trouble. I will not compensate you. Then the Indian company also gets to bear that market risk. Right? And what is the whole idea of risks? Alright, the whole idea of risks economically is higher the risk, higher the reward. Alright, so the principle is if the entrepreneur, if an entity is bearing higher risks, it should earn higher rewards. Alright, that is where in typical supply chains, when this Indian entity becomes a captive entity, and say the product, the item which is manufactured or developed by the Indian entity earns stupendous profits, the Indian company continues to get the costless remuneration. The supernormal profits are something which will be earned and enjoyed by the parent entity itself. We can take the case of Microsoft Office, Microsoft itself. So Microsoft, all of us know we use Office extensively. Office is primarily developed in the India development centers of Microsoft as well as in the US. And the Indian development center of Microsoft gets a cost plus remuneration. I think it's around 15 or 18%. But all of us know the international success of Microsoft Office as a product suite. Microsoft has made billions in profits by selling these products. But it continues to give India only a 15% markup on its cost. The supernormal profits that Microsoft US has enjoyed on account of licensing the Microsoft Office suite is something which it only keeps. Why? Because if the Microsoft Office suite had failed, US itself would have borne that risk also. It wouldn't have passed it on to India. Right? So whoever higher the risk, higher the rewards. This is the whole premise. And this concept was slightly, in that sense, slightly and with a far-reaching effect. This was modified by the OECD recently to say that, sorry, just to take a step back. With this whole concept, what was well acknowledged was functions follow risks. Alright? And therefore risks follow, rewards follow risks accordingly. So what did that mean? If we do functions follow risks, so whoever bears the higher risks, alright, also performs better functions. That was the whole meaning of this phrase of functions follow risks. Whoever bears higher risks also performs the higher functions, and therefore they were entitled to higher remuneration. So in this case of Microsoft Office and Microsoft India, assume for a moment Microsoft Office failed. Alright, it didn't get the market which it was supposed to get. In that scenario, the risks are being borne by Microsoft US. Therefore, that is performing the more important function, and therefore it was supposed to derive the supernormal profits. That was the premise. But then this was viewed adversely over time for the precise reason that they took the same facts and turned it around from another perspective, and they said, look, if the R&D and product development had not happened efficiently for the Microsoft Office suite, Microsoft Office wouldn't have succeeded at all. And therefore, the person who developed the R&D, who did the R&D on the Microsoft product and developed it, he performs the more important function. and therefore he should be compensated more. Such that, for example, even the Indian tax office went behind Microsoft and said, boss, the entire office suite was developed out of India. And therefore India is a key function. India's functions are key functions in your supply chain. Therefore India should also earn the supernormal profits. Right? And a lot of litigation has followed on that, even in the case of Google. So all of us would have heard about the Google tax, Facebook tax, etc. If we delve a little more deeper, those are more than tax issues, they are more transfer pricing issues. Because the premise is that the Indian market has contributed to the Google revenue. The Indian user base has contributed to Facebook revenue. And the user base itself is an important function which is sitting in India. Therefore, the share of profits of Facebook should be brought to tax and taxed in India. Right? So these are the whole dynamics of functions performed, assets employed, and risk assumed. With me till now? The interplay on this, and thereafter we will go to this concept of contractual terms, a transaction which laid on explicitly or implicitly how the responsibilities, risks, and benefits are to be divided. So, as the FAR is also documented in the contract. So, FAR is actual conduct, and contract is the legal form. So, we keep talking about form and substance, right? Substance and form and substance, etc. The second bullet talks about substance in that sense, implicitly. And the third bullet on contractual terms talks about the form. So, in substance, the Indian entity may be performing extremely niche activities, but in the contract, that is not mentioned. So, what will take precedence? From a transfer pricing standpoint, it is simple. The functions, that is, the substance takes precedence over form. That is how the law also is implicitly written. Right? Lastly comes the conditions prevailing in the market in which the respective parties to the transactions operate, including the geographical location and size of the markets, laws and government orders enforce costs of labor and capital in the markets, overall economic development and level of competition, and whether the markets are wholesale or retail. All of these aspects should also be analyzed as a whole idea. So, for example, if there is let's take the simple case of software development services again. Software development service providers in India are dime a dozen. Alright? Just kindly compare this situation with say Malaysia. Right? Software development is not as prevalent as it is in India as Malaysia. And how much has the government given a regulatory environment incentivizing that activity? In Malaysia, it's far less than what it is in India. And the labor force in India has also contributed to all of that. Alright, so why is this relevant? Okay, why this becomes relevant is when we determine the price of a particular transaction. Say when we say cost plus 15% is sufficient. Alright, why do we say it is sufficient? Why not cost plus 25? Alright, we take the case of software development again. If the activity is merely coding, testing, development, we will find enough number of engineers. But assume for a moment, there is a lot of data analysis, data analytics, data scientists who we would need for performing that activity. Data scientists are difficult to get today. Good data scientists are difficult to get today, whereas good coders are fairly easy to obtain. And therefore, getting that talent itself is a key function. And therefore, that should be compensated better. Well, if we take the same case and go to the US, in the US, getting data scientists, etc. fairly easy, but getting good coders is difficult. Because the Indian geography specializes in coders, whereas the US geography specializes in data scientists. And that is the point on conditions prevailing in the markets. The US market is different vis-a-vis the Indian market in this manner. Manufacturing connecting rods in the US will be a far more expensive proposition than in India. Right? Manufacturing cancer drugs in India will be far easier compared to the US because of the regulatory mechanisms over there. The US FDA puts in a lot of safety and regulatory requirements for pharma manufacturers. That is why they find manufacturing in places like India far more easier. Because Environment standards are fairly low, they are not extremely insistent. They do not add to the cost of the product. Right? So these are the dimensions on markets which we also have to understand when we understand a simple transaction like software development services. So on software development services, virtually the functional analysis, we have to write a mini thesis, so to say, on the software development activity. That is a functional analysis. Alright? Go to the next point quickly. Yeah, and this is the whole concept of why functional analysis is important. Even internationally, the OECD has been very much insistent that the functional analysis documents the arrangements strongly, because they have seen over time that the functional analysis, being the soul of a transfer pricing analysis, that is not written well, and that perpetuates profit shifting. Professionals write that it's a routine transaction, alright, the activity is a routine transaction, because of which the remunerations will also be routine and not abnormal. But over time, because of transfer pricing assessments not only in India but in other countries, tax administrations have realized that this is incorrect. Taxpayers are in fact fraudulently writing functional analysis, and therefore facilitating profit shifting. And that is why the OECD came down very strongly on all of this. And that's when it turned the tables and said, I mentioned you about functions follow risks. They said, no, it's high time we move away from that concept and say, and now they're saying risk follows function. So if you are doing an important function in the supply chain, the risks follow there. If R&D is an important dimension of the product, and that R&D is done in India, India bears the risks and India should bear the supernormal profits. Right? That's the thought which has which developed over the past few years, and in the OECD's 2022 transfer pricing guidelines, the OECD explicitly said so. All the developed nations and all these multinational companies were very much against this articulation, saying this follows function. They were very much against it. There was extensive lobbying saying this should not be done. But then OECD said, no, nothing doing. This is what it is. Again, where did OECD get that strength? OECD got the strength from US and UK and the European tax administrations, because those administrations were going behind companies like Google, Facebook, Apple. And the representations were that Google, Facebook, Apple, for them, the R&D is the key. The market is the key. And the articulation which they were giving was the parent companies who are located in tax-free jurisdictions such as Ireland, they perform the important functions. And therefore, the supernormal profits should accrue to entities located in Ireland, US, etc. Because there are no tax jurisdictions. Google India Private Limited is one of the largest employers of software developers in this country. Right? You can just imagine the number of people there. But they are given a cost plus 15, cost plus 18% margin, and they are done with that. Supernormal profits, who wants? Google Ireland. This is what the OECD has been attacking, and that's why writing that functional analysis has become extremely important today. And even tax authorities slowly, they are understanding that instead of comparables, if they go behind the functional analysis, there is far more scope for tax collection. Okay? And then again, the point becomes alignment of economic reality, legal reality, and accounting reality. How do you write all of that together? Because economically, they may acknowledge India may be very important, but then in the contracts, that is the legal reality, it is said that the US is the most important player in the supply chain. Accounting may speak some other language, and that is why OECD is insisting that all of these realities should be aligned. You can't say economically India is not important and legally say economically India is important, or the other way around. You have to be consistent across all of these three. Again, the focus, like I was saying, was form and substance. Both should be aligned. Therefore, if both are aligned, there is no question of form over substance, substance over form. We will not have those debates. If the form and substance are aligned, there will be no debate of form over substance, substance over form, and all those arguments which came in Vodafone, looking through, looking at, etc. Right? This is something which even the OECD has been insisting. Therefore, This functional analysis, which seeks to identify the economically significant activities and responsibilities undertaken, assets used or contributors assumed, is the most important part in a transfer pricing analysis. Okay, yeah. So OECD is currently terming them as risk follows function, which I said. What the parties actually do and the capabilities they provide. So in sum and substance, this is what is functional analysis. This is what is to be documented. What do the parties do? What are the capabilities that they provide? This is what I've been speaking about the past 35 minutes. Okay, so with that, value-added activities. Value-added activities are the focus of a functional analysis. Who undertakes the value-added activities in the supply chain? So, for example, if you take this connecting rods and rock-arounds concept, if it's a niche product, the value-adding activity is in fact from the US, and in India, the Indian entity is a routine manufacturer. So, it's not much value addition which is happening. Not only the subsidiary company, any third-party provider can provide that service. So, who is providing the value in that entire transaction? It is the US entity. Because the US entity knows where to put that rock around in the engine. Yeah. And that rock around is a fairly routine product. And that's why identifying value added activities is an important dimension in our transfer pricing. This is the language which is given in the OECD. So whatever I have explained is in very simple English, and the subsequent slides they factor the jargon in the OECD. So I will not spend a lot of time over there. So I think we'll take up the conceptual areas. So how do we go about a functional analysis? Okay, so we just have to step back and look at the multinational enterprise group whose transfer pricing analysis we are doing. What we have to look at is, just take a step back. Multinational enterprise, what is it doing? First we need to understand it. Manufacturing of automobiles, development of accounting software packages, manufacturing of cancer drugs. That. How is the structure and organization of the multinational group? We have to see the org chart. How many people are there in the US? How many people are there in India? Who are the people who are there in the US? Who are the people who are there in India? Is the head and brain in the US or the head and brain is in India? Is India only the arms and legs, or the US also has arms and legs? Are there delivery people in the US as well? Alright, how do they influence the context in which the enemy operates? Are the decision-making people in the US, in India? All of this we need to ask, and we need to get answers, and we have to write them down. Right? Again, this functional analysis exercise is a very one-to-one exercise. So, all of these questions we put it out in a questionnaire and then send it to the client and ask the client first answer all of these questions, or take the questionnaire, sit in front of the client and ask him all of this. If we are very familiar with all of these questions, it becomes a simple conversation with the client. Okay, what do you guys do? In 21-22, what were their new products, or whether the old products? How were they designed? It was designed from the US. So India only did the incidental manufacturing? Yes. We get a lot of answers over a simple conversation. And that's why functional analysis is done particularly through interviews. Okay, so we call them functional analysis interviews. Because only through a one-on-one discussion do we get all of these answers. Right? And as soon as we get an answer, we need to process that and ask further questions to get a more sound grip on the particular transaction. Thereafter, what is the next conceptual area to be addressed? What are the legal rights and obligations of each of the parties in performing their functions? What is the economic significance of those functions in terms of their frequency, nature and value to the respective parties to the transactions? That is important. Now again, let's take the case of the accounting software development. If the design was being done by the US entity compared to the design being done by Indian entity, design is an important dimension of a software product. If the design is not proper, arguably the entire product fails. Alright? But can the design function be done by anybody else in a better manner? Is the other question also which we need to ask. Right? So for example, coding is a very routine activity, and coders can be engaged very easily, but designers are actually difficult to get in the market. And typically, because of the shortage of skills in, say, design, it is typically done by the parent company itself. And therefore, one critical value-added function one economically significant function is not in India. And if that economically significant function is not in India, then the activities of the Indian entity become less important vis-a-vis the supply chain. Therefore, we can say that the Indian entity is doing very routine activities, it ought to earn a very small margin. Alright? Again, all of this is dependent on whether the foreign FCO group functions, whether it is a manufacturing, trading or service entity. This is all. So I gave you the example of a manufacturing entity. The way you look at a manufacturer for a functional analysis is slightly different. Services, you need to ask a different set of questions. If they are only, say, traders, say for example, Walmart. Alright? Walmart has an extensive sourcing arm in India. Alright? What does Walmart do? Walmart buys good quality products and sells them. It does not manufacture anything. Right? But there are some products which it gets manufactured, but Walmart is known for its distribution reach. It has these huge stores in the US which generate a lot of sales. So, what is the value adding function for Walmart? The value adding function for Walmart is sourcing. For example, for a long time, there is this company called Welspun in Gujarat. Right? Apparently, Walmart used to source all of its towels from Welspun. Right? And for that, it had an entity in India. Right? So, for the towels activity, so if we take the case of Walmart, sourcing itself is an important function. For a software company, sourcing will not be an important function. Design, coding, implementation will be important. For a manufacturing entity, again, for an automobile manufacturing entity, the design of the car design, engineering, those are critical activities. Right? So we need to understand which is the multinational group which we are dealing with and what is the important economically significant activity for that multinational enterprise, and that depends on that multinational enterprise itself. All these while I was giving you the example of a US parent and an Indian subsidiary. We will also find cases where the headquarters is the Indian entity and it will have subsidiaries outside India. We have Indian multinationals becoming popular these days. So the questions get flipped when we are dealing with Indian multinationals. That's why when we do a transfer pricing analysis, we need to just take a step back and see what is the transaction we are dealing with and who is our client. Such an elementary question. Alright, very elementary but extremely important because that determines the direction of our functional analysis. Okay, because if it's an Indian holding company and an Indian operating company, it will have subsidiaries outside India primarily for marketing. And then therefore, if you are doing a transfer pricing study for an Indian headquartered company, the functional analysis will have a different tone and tenor altogether. The value added functions will be in India. The entrepreneurial risks and returns will be sitting in India. Right? We need to ask questions around that. And what are the questions that we should ask? Questions would revolve, for example, on manufacturing, on the research and development. Who does the research and development? Does India do it? Foreign company does it? Has it outsourced it to somebody? Raw material sourcing arrangements. Does the parent company give directions on how the raw material is to be sourced, or the Indian company takes those decisions? Because finally, from an economic standpoint, economically, the decision maker is the person who is rewarded. Because the presumption thereafter is that the person who decides bears the risk of his decision. So if there has been bad quality products sourced, alright, who bears the risk? The sourcing team will bear the risk. If the sourcing team is in India, it will bear the risk. Those people could get fired. Right? That's the important, that's how we have to go about asking questions. Sourcing is an important dimension. Inventory policy. Who drives the inventory policy? Does the Indian team decide the inventory policy, or the US entity has done the inventory policy in the context of manufacturing? So in the context of, say, let's flip it, let's say it's an Indian multinational. Okay, in the context of Indian multinationals, what happens is typically they manufacture the products and the subsidiaries are primarily marketing arms. So the Indian entity plays a key role in all of the activities of the group. They are centrally controlled in that sense compared to, say, US or European groups. Far more centrally controlled than others. And there it will be fairly easier to say, yeah, everything, the buck stops, so to say, as an Indian entity. But with American or European groups, they share the decision making, and it's important to track that. Right? Production. Who defines production, manufacturing, infrastructure and scheduling? Process engineering, who does that? Quality control, who does it? So what we've done here is broken up that manufacturing activity itself into all of these components and ask questions as to who does this, who bears the risk on account of the decisions here. Okay? Outward supply, marketing, sales and distribution, post-sales support. These are all the various dimensions for a manufacturing entity. Similarly, we'll have to map out what are the various dimensions for a service entity. What are the various dimensions of a distribution entity? Say for example Walmart. For Walmart, what will all of these functions be? What questions should we ask? For services, what questions should we ask? To get a deeper insight into the activities of the company. Decision making in relation to all these matters, where does that happen? Extremely important question. Right? Because if all of you are familiar in the context of income tax, the head and brain is given a lot of weightage. Because the head and brain decides. Arms and legs only execute. Head and brain decides. That's why this decision making, which is the entity in the supply chain which drives this decision making, is an important dimension. Right? So the questions which we should ask are: kindly share the organization structure of the group. FCO group or INCO group, whichever group. Please ask this organization also, because they will give one diagram. And we have to understand how the diagram looks like. Is it weighted towards the foreign entities side, or is it weighted towards the Indian entities side? Okay. What is the team size of the FCO group? How many people are there in India? How many people are there in the US? So especially with technology companies, there may be around 4 to 5 or at best around 10 people in the US. Okay. But there will be 1,000 people, 1,000 member engineering team in India. Alright. That's the tax authority is saying. First, from a headcount standpoint, all of the entire group is in India. Therefore, India should derive the premium returns. Alright? For example, if you take Uber is a Netherlands-based group. Alright? It has an extremely, in terms of numbers, the network which Uber has in India, I think very few countries. It won't have this network anywhere in the world. So if one looks at Uber globally, if Uber were to put out its global organization chart and say the network which it has around the world, it's so easy to infer that India is one of the largest markets for Uber. And if the market is huge, the profits from a particular market should also be huge, is a logical direction which we will go. But there are many other nuances saying in India, the recovery is very low. Profitability is very low. Keep those dimensions aside. But then, if we look at an organization holistically, and such as Uber, and if we see India taking a large share in the network, we will say, okay, this entity seems to have a lot of presence in India, and therefore, in India it should pay more tax. There are many nitty-gritties here. Right, let's not get into it. But from a perception standpoint, we need to address it and set the context. Fine, it may have a great network, but the Uber technology is something which is managed and driven from Netherlands. Netherlands is the head and brain. India is only the arms and legs. And therefore, Netherlands is the entity which should conceptually earn the higher margins. To the extent there is an extensive network in India, for that let India earn a corresponding remuneration. But please don't attribute remuneration related to decision making to India, because decision making is happening in Netherlands. But assume for a moment, Uber's founder is sitting in India and taking those decisions. Right? Situation becomes a little murkier. It becomes a little difficult to answer. Right? All of these questions we get to know when we ask simple questions like organization structure, team size. This is the kind of insight which we will get if we ask these questions. What is the geographic spread of the FCO group? So the group says we are a multinational enterprise. But then it will operate in 5 countries, of which India is the largest market. Alright, India is the largest market. What do we do with it? Isn't it an Indian group? The tax office, the income tax department will say, look, boss, you are an Indian group. All your revenues are from India. Therefore, your profits in India should be high. You can't show a loss in India. That is how they will argue. How do we rebut all of that? That's why we need to go a little deeper and say, no. The critical value-adding functions are not in India. The critical value-adding functions are outside India. And let's take the case of an Indian multinational, right? So Indian software companies, their markets are primarily outside India. Their customers are in the US. The US IRS will come around and say, boss, all your customers are in the US. So US is the key market for you. All your key profits should be shown and offered to tax in the US, not in India. Right? The functional analysis should help anybody to answer those questions easily. Right? What are the broad qualification skill sets of the team in India and outside India? Typically, if you are well qualified, you are based out of the headquarters. That's the whole presumption. And in India, it may be some engineers, etc. But if you have, say, PhD holders in India, what do? The skill sets of the employees are PhD holders. There are some high-end scientists who get paid 1 crore a month. It begs the question, why is the company paying them 1 crore a month when the CFO salary, CEO salary itself is 2 crore a month? Question, value added function. Where is that value added function? He may be a PhD holder, but he is a cost center. He is not a revenue center or a profit center. Please appreciate that is what we have to articulate. Right? Key jurisdictions of FCO group customers. So, like I was saying, if India is a key market, it changes things. On the other hand, if we say, no, US is the key market, we are only a support service provider, it changes things. Okay? Key competitors for the foreign company. To identify whether something is routine or non-routine. So, for example, in the context of automobiles and cars, if the only competitors, so we are making, say, sedans, right? But the only competitors are, say, Ferrari or Lamborghini. It changes things. There are no competitors in this segment. Therefore, this company is a monopolist in the market, or arguably a monopolistic, has a monopolistic presence in the market. That changes things. That changes the functional analysis. Right? That changes the kind of comparables you can take. Right? That's why, in the context of Sony, for example, when Sony went through its transfer pricing assessments, one of the comparables was Videocon. Right? Because Sony was manufacturing televisions, Videocon also used to manufacture televisions. From the way they wrote the functional analysis, the company was able to say that, look, Videocon is a comparable which the TPU has provided, but there are large differences between myself and Videocon. Therefore, Videocon cannot be my comparable, although it manufactures televisions. This was demonstrated. How? By way of a strong functional analysis. They said, why you Videocon will not be a comparable? Although they manufacture televisions, and Sony was also manufacturing televisions. Right? India revenue vis-a-vis consolidated revenue. Again, this Uber example which I gave. Okay. Again, driver of profit for the FCO group. We have one more time. Is it a factor of delivery excellence, pricing capability, or ability to deliver good quality deliverables at lower cost? So now, what is the driver of profit? This is an important question which the OECD has raised. Saying, how do you earn that profit? Why do customers come to you? Is it because of you provide low cost services, or because you provide your services very well? Is it uniqueness in delivery? Alright? These are questions which only the company guys can answer, because they know why customers come to them. Right? And this is an important dimension in pricing, because if it is because of low costs that a group has a customer base, then the profit margins will be low. Because with low costs, you cannot say my profit margins are high. But on the other hand, if it's not low cost, but it is because of delivery excellence, that how beautifully they are providing a product experience, then we can charge a premium profit. And if that delivery excellence is being contributed by the Indian entity, then the Indian entity can say, look, I am contributing to the delivery excellence, I should derive a higher remuneration. 15% is not enough. Right? Or competition in the market, again, it's a monopoly market, there are no service providers, because of which I am able to get a premium pricing, premium profits. Then The value driver has not got anything to do with the company. The value driver is outside the company and the uniqueness of the market that there is no competition. There is no competition, that's why they are making supernormal profits. Then we cannot attribute it to the functions at all. The FAR will have no connect with the profitability because it's connected to something external. Right? That is where questions of value chain will be, value drivers will be relevant. Allocation of these value drivers in India and outside India. The value drivers, are they in India or are they outside India? And how do you expect this allocation to pan out in the next 2 years? Is there evolution which is happening in the product because of which people from India may go to the US and therefore value drivers will shift to the US, or value drivers will come down to India and therefore 15% is not sufficient, I need 25% or I need 10%. Right? Again, on the functions performed, strategic direction of the INCO is decided by the person employed in the FCO, INCO or any other geography. So we went through this. How is the decision making on people matters? So the Indian CEO is appointed by whom? Is it appointed by the US company or the Indian board? Or by both? Important question. How is it spread out geographically? How is the reporting structure given the geographical spread? How critical is the marketing function for the FCO given the current stage phase of research? So all of us are familiar with startups. Startups, in the initial years, they have to first get the beta version of their product. After that comes marketing. So in the initial stages, the way the functional analysis will be something different. And as the product attains go-to-market, which is ready for marketing, the functional analysis changes. Because after the market is ready, marketing becomes a critical activity. Right? We need to understand all of that. What stage is it in? If it is a startup, initial 1 or 2 years is the product development stage. After that comes the product marketing stage. Then please describe the supply chain or service delivery chain for the FCO group. These are the questions we have to ask. Please explain everything. Product development, R&D, customer marketing, contracting, production, delivery, invoicing, post-sale support. Service context, how does this work? This is manufacturing. For service, how does it work? For distribution, how does it work? As chartered accountants, we won't be able to articulate this as well as the company can. So this is something which the company itself should give, and we should deliberate and ask them counter questions to get our understanding deep. How is cross-country accountability and responsibility fixed in the FCO? Typically, when companies operate across geographies, they work together. How do they assign responsibilities and roles? How does the reporting happen? Dotted line reporting, hard line reporting, no line reporting. Right? We need to understand all of that. Are there any intangibles relevant for the FCO, such as proprietary software, internally developed modules, unique know-how, etc.? So the case which I gave for the manufacturer, if it's patented technology, the value, the profit driver or value-added component is from outside India. It's not within India. These are questions which get those answers, with which we can get those answers from our clients. Please share a copy of the end customer contract. Very important. When we look at when we simply say software development services, we are not able to visualize what software it is. We won't understand if we ask them and he describes something. The best way to understand it is to go through a customer contract. If we see a customer contract, we'll get to know what they are really doing. That will be a lot of legalese, a lot of legal English and all would have written. We have to ask them, boss, will you please explain your customer contract? What are these services which you have written? What are these goods? How are they used? Because he will give the finance guy will give one explanation, the CEO will give one explanation. In the contract, there will be some other note. Right? We need to go through the customer contract. We need to go through the invoice which they raise on that customer. In the customer contract, they would have said software development services. Right? But in the invoice, they will say IDS, IT enabled services, or business support services, or consulting services. The nomenclatures will be so different. And then the question comes, boss, why did you describe the transaction in this manner in the invoice? Why is it different in the customer contract? Right? Very typical audit checks. Finally, if you go down that road, these are finally questions we ask when we do our audit. Please share a copy of the intercompany agreement between India and FCO. Please share a copy of the intercompany invoice. What is the basis of pricing of the FCO offerings to the client? So, in the context of say software products, it is typically given as a subscription fee. For 1 year, the fee is $2,500 or $20,000 or $200,000. We need to understand why they have done it in that manner. Why not service fee? Why have you done it as an annual subscription fee? Why not fixed fee? Right? These are the questions which we need to ask when we see the pricing methodology also. Even the pricing methodology should lead us to many more questions. Okay? And then questions on risks. What are the market risks? Who bears the market risk? What are the inventory risks? Who bears the inventory risks? How significant are these risks? Right? Credit and bad debt risks. Does your company have this kind of credit or bad debt risk? Because some clients, they operate on advance basis. Only if you pay them in advance, will they provide you the service. So for them, there will be no credit or bad debt risk. But some people give a 60-day credit limit. The point is, who bears those risks there if they don't pay? Right? Foreign exchange risk. How significant is this risk? Who bears this risk? Who develops the risk management strategy? These are all the questions that we need to understand. Lastly, entity characterization, whether full-fledged manufacturer, service provider, distributor, or limited risk manufacturer. Finally, when we ask all of these questions, the inevitable conclusion that we will arrive at is whether the Indian company was providing software development services was a limited risk service provider or a full risk service provider. And if we take the example of this connecting rod rocker arm manufacturer, was he a full risk manufacturer or a limited risk manufacturer or a partial risk bearing manufacturer? Because full risk manufacturers, full risk service providers are the ones who are supposed to earn the premium profits in the supply chain. Limited risk service manufacturers, limited risk service providers are typically entitled to routine margins. That's where entity characterization will become the last part of a functional analysis. Because when we ask those questions on who performs these functions, what are the assets they employ, what are the risks that are assumed, this is the final answer that we get. And based on this, we identify our companies. So if our company is a limited risk entity, we compare it with, say, software development service providers, classic case. Software development service providers operating on cost plus 15% basis. The income tax department comes and says, a comparable for software development services is Infosys. How is Infosys a comparable? If you apply these tests of FAR, Infosys will never ever become a comparable. That's why functional analysis becomes very important, because the department will come and say, look, Infosys has earned 45% margin, you earn 15%. Make an addition of 30%. That's why if we write our FAR properly, we'll be able to clearly say why Infosys will never ever become a comparable, because the functions which Infosys provides is extremely different. It may be software development activity. That does not mean I'm a comparable. Take the example of the plastic bucket manufacturer vis-a-vis a plastic components manufacturer which goes into a 3D printer. Both of them deal with plastics, but where do they end up in? That is an extremely important and subtle difference which has far-reaching consequences which very few people relate to. For example, there are software service providers whose activities, whose development goes into networking equipment. Alright, that doesn't make it comparable to an accounting package provider. There are extremely different end users. Different end users means different FAR. Very important. So what I would request is kindly keep that plastic bucket manufacturer example in mind. Okay? Else we'll end up comparing our simple cost plus manufacturer service provider guys, software development guys with Infosys. Okay? With that, we'll wind up this section on functional analysis and we'll go on most appropriate method. I'll just quickly take you through all of this because we are running a little short of time, because two heavy topics on a Saturday morning and only 1.5 hours. We can't do justice to this, but I'll try to do what best I can. So after we've done the functional analysis, the next question comes on economic analysis. Typically in a TP report, it's bifurcated into 3 or 4 parts. We have the introduction, we have the industrial overview, we have the functional analysis, and then comes the economic analysis. As part of the economic analysis, we go and identify the comparable company. So now with the functional analysis, we've done a deep dive of the transaction itself. We've gotten to know the taxpayer very well. Now we have to get to know the comparables well. Alright? How do we get to know the comparables well? Before we get to know the comparables well, we need to know which method are we going to adopt to determine the arm's length price. So there are 6 methods to determine the arm's length price. Comparable uncontrolled price method or the CUP, and then the resale price method RPM, cost plus method CPM, profit split method PSM, transactional net margin method TNMM. Lastly comes the newly introduced other method. 6 methods. Right? So, of the 6, which is the most appropriate method is the question. The most appropriate method is to be determined based on whichever gives the most reliable measure of the arm's length price. Whichever gives the most reliable measure of the arm's length price. Extremely subjective and very vague definition, but it gives a few parameters. We have to apply these parameters to freeze the arm's length price. How do we identify which is the best method? We have to see what is the nature and class of the international transaction of the SDU. Then, class or classes of A is entering into the transactions and the FAR performed by that. Okay, so we need to perform the FAR of ourselves, we need to perform the FAR of the comparable companies as well. Availability, coverage and reliability of data necessary for application of the method. Do we have enough data to apply the CUP method? Do we have enough data to apply the RPM? Do we have enough data to apply the CPM? So as we go into the method, we will understand when some method can be applied over another. The degree of comparability existing between the international transaction, extent to which reliable and accurate adjustments can be made, nature, extent and reliability of assumptions required to be made in application of the method. So these are the 6 parameters which are there. We go to the methods and then we try to correlate it with the choice of the method. First is the CUP method. Price charged or paid for property transfer or services provided in a comparable uncontrolled transaction is identified and adjustments are made if required. So CUP method is the oldest method in transfer pricing. Right? To give extremely simple examples, if there is a transaction of say sale of distillery bottles by one company to the other, both related parties, have distillery bottles been sold by any of those entities to unrelated parties? Or are there transactions of distillery bottles between third parties? Are we able to get the data? Okay, so just to take the case of the connecting rods rocker arms case. India is manufacturing rocker arms and giving it to the parent company. Has India sold rocker arms to another unrelated entity? Has it sold? So that is the question we have to answer. And if the answer is yes, that becomes a CUP. If it has sold it to another unrelated entity, that itself becomes a CUP. And therefore, because we have the data that the manufacturer has sold similar products to an unrelated party, the price there itself becomes a comparable uncontrolled price. So therefore, if say it has sold the rocker arms to the US parent at say $100 apart, but if it has sold the same rocker arms to that unrelated party at $130, $100 here related party, $130 there. Okay, then we can say that the transaction is not at arm's length because on the related party transaction it has charged lesser, but on the unrelated party transaction it has charged higher. Therefore, there is shifting of profits or separation of profits. Again, the next question comes is, assume I have sold 1 lakh parts, 1 lakh rocker arms to the parent company at $100, but I have sold only 1,000 rocker arms to the unrelated party at $130. Product comparability is there, but volume comparability? Obviously, if I sell high volumes, I will sell it at a lower price. Right? I will sell it at a lower price. Does that make the product, does it make a CUP? Not really. Because comparability is not only in terms of product, it's also in terms of the value and the volume. So, if I have sold 10 lakh parts or 1 lakh parts and I am comparing it with the 3000 parts volume, that is not a good comparison. CUP does not exist. It fails the test cycle. Right? And in reality, getting CUPs for primary transactions is slightly difficult. That's why the most popular of all of the 6 methods is the TNMM method. Right? Unless the In terms of popularity, so to say, TNMM tops the list, and then comes cup, and then comes, in the case of trading, the resale price method, and then comes cost plus method, and then comes the profit split method. The other method is a slightly interesting method, in the sense that the way it is worded, we'll actually spend time there. In practice, although it is not the right thing to do, if none of the methods are appropriate, we complete the 3CB saying the other method is the most appropriate method. Alright, we'll go to that question as to why. Alright, and so typically the cup, fairly simple to understand. If we have a comparable uncontrolled price with a third party, it's a good. So what is a good case study is resale of same products by FCO to a related distributor, India Subco, as well as a third party distributors in India. So the parent company is selling products to the Indian company, it's also selling the same products to third party distributors. Comparable volumes, and please bear the word same. 100% product comparability should be there. Right? Then cup is a good method. Resale of similar products by FCO to a related distributor, again here the difference is same, similar. There is no exact comparability. If there is no exact comparability, there is a dilution. Alright? Resale of products by FCO to a related distributor to India Subco that are not comparable to those sold to third party distributors. ABC products are sold by the FCO to the India Subco. DEF products are sold elsewhere. No cup. Okay? Fairly simple to understand. Resale price method, you can go through all of this, but then primarily the resale price method is applied in the context of traders. So if there is trading without any value addition, okay, goods are purchased and resold with extremely limited value addition, such as only repacking it and selling it, that is when the resale price method becomes relevant. And the resale price method uses parameters such as the gross profit, because that is the best measure to identify the area. They will compare the gross profit margin of the our company and the gross profit margin of comparable companies on same or similar products. So cup required exact comparability or near similar comparability. With RPM, cost plus method, TNMM, etc., we can dilute similarity. That is the premise why the tax office considers Infosys as a comparable for captive service providers, because it adopts a TNMM in such cases, and with TNMM, the product similarity is diluted. Right? Exact similarity is not insisted, because that is the foundational principle of TNMM, that you will not get data on exact comparability, and therefore we need to dilute our selection parameters. Right? The same principle applies for RPM. So you need not get exact distributors. If you get similar comparable products, good enough. For example, if there are electric parts being sold, electric parts will be dime a dozen. Alright? But one distributor of electric part can be compared with another distributor of electric part. It may not be similar, but it's under the broad genus of electric parts, you can compare them. RPM permits that, CPM permits that, TNMM permits that, right? But CUP does not permit it, and that is where RPM is slightly popular, particularly for traders. And this is the same example: resale of same products to a related distributor. Resale of, again, in RPM it is resale, not manufacture. Alright? RPM is used only for traders, no other set of products. Alright? Then comes cost plus method. Cost plus method again is for manufacturing, no other transaction. In the context of services, it is very difficult to apply because cost plus method requires the gross profit computation. For service companies, we will not get gross profit computation. Only for manufacturers, we get gross profit. We have gross profit data. For service providers, typically we will find it difficult to get gross profit data. Therefore, cost plus method applies primarily to manufacturing companies and where we are able to get gross profit data. If gross profit data is available for a manufacturer, then a cost plus method is a good method to choose. Right? Profit split method is this is one of the rarely used methods. It applies only when there are transactions which involve unique intangibles. Alright? Unique intangibles are there in the transaction. Say for example, an IP is being developed jointly by two companies and it is being used by both. The IP developed by one is used by the other and that company, and this company, whenever it develops IP, it is used by both the companies. So you have to charge for those services of intangibles. How do you do it? PSM becomes a method. PSM is extremely difficult to apply. Just see the third point, because again PSM is a net profit based method like TNM. PSM requires the relative contribution made by each of the A. So in the joint development which I mentioned, how do you identify relative contributions? Identifying relative contributions is extremely difficult. It's extremely subjective. One entity will say no, company A, the activities of it contributed 80% to the profit. Some other team member can say no, it contributed only 60, mine contributed the rest 40. Right? So getting that contribution ratio is extremely important in profit split method. Right? Without that contribution allocation, PSN is extremely difficult to apply. And finally, having said that, transactions involving unique intangibles themselves are fairly frequent and low in the market. Right? Then lastly, and again, the way of computing, applying the PSN is extremely complex. As well, there is virtually no precedence on this idea, although it is the department's favorite method, because for them they are very clear. US company has earned $100 in profits, India should get 40. For them, profit split, that is all that it means. Whereas they don't appreciate the fact that this applies in the context of unique intangibles alone. Right? They look at it in the GP, they apply, the many transfer pricing officers look at transfer pricing is, they look at it in the context of GP ratio. So all these smart traders, one fellow had a higher GP, the other taxpayer had a lower GP. The same principles they applied it in transfer pricing without appreciating that there is much more deliberation which you require in transfer pricing. And coming back to PSM, it's a fairly complex method to apply. You can just go through this to appreciate the complexity involved. Alright, in practice, very less of it is used. I have just put the text because it gives you an opportunity to go through that language. And that itself, again, law is difficult to apply when law speaks a lot. And this is one example. And then lastly, TNMM, which is the most popular method, it compares the net profit margins of two entities, of the taxpayer and the comparable companies. This is fairly easier to get. We have databases, proprietary databases to which we subscribe and identify comparable companies. And net profit margins are compared and comparables are frozen and the arm's length prices established. So this very popular for manufacturing, for services, for traders. For traders, just in case we are not able to get gross profit data, which is very rare, because if we lay our hands on the financials, we are more or less able to work out the gross profit, restricted to cost of goods consumed and all of that. But with non-traders, TNMM is the most popular method and the most easiest to apply. Provision of services, and like I was saying, TNMM does not require exact comparability. It requires broad comparability, but then again, keep in mind the example of that plastic bucket and software development service provider and Infosys. There are these shades of grey which we can deliberate and engage on if we get a functional analysis very well. Lastly, the other method is also worded very broadly. Any method which takes into account the price which has been charged or paid, or would have been charged or paid, with or between non-AEs for similar uncontrolled transactions under similar circumstances, considering all relevant factors. Extremely widely worded, which is where in case any of the other 5 methods don't apply, the default is to go with the other method. But then we need to be able to explain why we chose the other method. It's very straightforward to apply this to sell off shares. Typically, when we sell shares, we apply the net asset value method, book value method, or the DCF method. Right? Because that is typically the method which is also applied for same or similar transactions between non-AEs under similar circumstances. For sale of shares, other method makes a lot of sense, especially when you have a valuation report which backs the valuation, because that clearly satisfies Rule 10A. Right? But with other cases, it's very difficult to identify. Payment of interest on loan. Typically, interest benchmarks are made keeping in mind, say, the RBI rate or the SBI PLR rate, or earlier the LIBOR rate, or the alternative international rates that we have. For such cases, the other method makes a lot of sense. Right? But then, just because we are not able to fit it in any of the five, doesn't mean we come into the other method. We need to come to the other method with a lot of deliberation and having thoroughly considered at least TNM. Because in many cases, say of provision of services, manufacturing of goods, TNM will generally help. But if we go to other method without looking at TNM, then maybe our analysis is incomplete or incorrect also. Right? We need to keep this in mind with the 6 methods. In terms of popularity, like I said, and simplicity and ease of application, availability of data, TNM tops the list. After that comes CUP in some cases, then RPM, CPM, PSM. Other method, yeah, we'll keep it outside that circle, so to say. Okay, so that's all that I had today. Hope the concepts were fairly straightforward and you were able to digest them. You can go through the slides, and the Institute's guidance note on transfer pricing gives a lot of insight into the other methods. Unfortunately, on the functional analysis, it closes the entire discussion in around 5 pages. So that's why I thought we'll deliberate more on the functional analysis than the other method and then the methods. So the guidance note is helpful. We would also encourage you to read the OECD TP guidelines. It's a little bit dispiriting because of the language, and the sentences start somewhere and they end somewhere. Very difficult to read, but extremely well thought out language. I would encourage all of you to read that also to get deeper insights into the functional analysis and the methods. Okay, with that, thank you so much for being a very patient audience. So do we have any kind of questions we can take? Right, any questions? Happy to answer.
Do transfer pricing guidelines and TP authorities recognize the newly followed cash burning model? Right, many companies like Flipkart or something.
Yes.
Because
So
it is in the disguise of future business valuation.
Absolutely.
It won't be in the revenue profits.
Yes.
So how does this has been seen?
Yes, so applying transfer pricing, particularly in the concept of startup companies which burn cash in the initial years, has been an open debate.
Yeah.
So they, one thing which, if not tax authorities, at least tribunals appreciate is cash profit. Alright, but then with startups you have a unique set of facts. What is the unique set of facts? They are not going to earn profits for 5-6 years. Now, how do you find comparables for them? Alright, that is a particular challenge. That is where when we are dealing with startups, the approach, typically the kind of startups that we see is, there is a US company, which is a holding company, so to say, and the Indian company is a service provider. The market is in India. Alright, and sorry?
Selling to unrelated parties.
Yes.
It is not to associate enterprise.
No. The thing is there, what happens is services are provided to the parent company who is burning cash. The parent company is burning cash, but within the parent company and the Indian company, we insist that there be a cost plus 15% or cost plus 18% markup. But otherwise, if you have AE transactions and your business model requires you to earn losses in the initial years, that is where the concept of economic adjustments come in. Like we saw in the context of functional analysis, conditions prevailing in the markets was one parameter. And then, okay, sorry. Let me just go to that. So what we tend to do in those circumstances, just a second, please give me 1 second. Yeah. Conditions prevailing in the markets in which the respective parties to the transactions operate. We use that language in Rule 10b-2b to ask for adjustments to the profits themselves. So what we say is, we are an entity operating in the startup phase, whereas the comparables are well-established companies. We cannot compare startup companies to well-established companies. Therefore, there are many factors based on which we need to undertake what is called an economic adjustment. And therefore, when we apply those economic adjustments, we normalize the profits of our client and bring it on par with well-established companies. That could be on account of capacity utilization or employee idle time, etc. So what we do, we have losses on the one hand and we have comparables to make profits on the other. We say that they are not really comparable. If you want to make them comparable, we need to undertake economic adjustments and bring them on par. That is the approach which we adopt. But this is not typically accepted by the tax authorities. We have to fight it out.
So cash burning model is not a sustainable.
It's a litigious model. It's a litigious model. Thing is, see, there is business sense in that model. They know why they are burning the
That
cash.
is my business strategy.
That is their strategy.
I can't override.
Exactly. See, tax follows business.
Yeah.
Alright. Therefore, if that is the strategy, then that is something which tax authorities would not appreciate. But then we have to make out a case as to how we can normalize this with well-established companies. But the difficulty there also comes with the fact that those adjustments are also difficult to make. That's why we find it particularly troublesome with cash burning companies.
It's open-ended.
It's open-ended.
What I have to do.
That's why the only way out is to make economic adjustments. So look at cash profit, please exclude depreciation. Or look at GMP, look at my gross profits. At a gross level, I may be making profits. Or there was intense marketing discounts, marketing connected discounts which I gave because of which my revenues are low. So can I make an adjustment to exclude those marketing expenses and therefore shore up the purchase price? These are all adjustments which we have to consider to make our case.
Your presentation is not in the booklet.
Yes, actually I took some time to prepare it, so
Yeah.
to say. So I think, the team can circulate it. Yeah, the soft copy is there, so it's being ready.
The cost of piercing into the market, the startup company.
Yes.
But we are doing the economic adjustment, they are not allowing.
Yes, sir. So we'll have to fight it out, like I said, we have to fight it out in the tribunal. And tribunals have been very forthcoming if we are able to demonstrate why those adjustments were made in line with Rule 10b2, 10b3.
So I have one question.
Sure.
So in the case of a lot of startups, as you said, the parent may be in the US and you have a subsidiary in India who is mostly developing the software, and the parent would be still in the development mode and takes all the risks of the business and all that. So they are making heavy losses.
Yes.
But still we are booking, say, a TNMM method and
Cost
we
plus
are using
15.
a cost plus 15 or something. Can that 15 be reduced? Reduced in the sense justifying that the parent is making heavy losses, and therefore this can be something like a 10% or something. Is that argument which can
So
be
there
made
are
out?
two dimensions to it. One is the parent company is making losses. The other part is 10% instead of 50. Right? We need to take they are two different arguments. Alright. So now when we say that the parent company is making losses, therefore please keep our remuneration low. Are we willing to keep the Indian company as a risk-bearing entity?
No.
Alright. That's the question. If the answer to that is
No, then you can't argue that.
right. So that's when we take this chance of reducing the profit percentage. 15, can we take it at 10? Yes, but that is taking a chance. See, TP studies go with a fairly wide range, say around 10% to 18% would be the 35th to 65th percentile range. Alright, but then if it gets picked up for TP scrutiny, they start with 25.
Yeah, and one more thing to the same thing.
Sure.
So the CEO of the company,
Yes.
okay, who is also a director in the US entity
Yes.
and is also a director in the Indian entity, and
Right.
is sitting in India.
Yeah.
How does the situation
Yes.
change?
So is the CEO I presume is the employee of the Indian company?
Yes.
Correct?
Yes.
So that is where this OECD's concept of risk follows function comes in.
Right.
And then the premise is that since the CEO is based out of India, India is a risk-bearing entity.
So
Alright?
then, so the whole dynamics change. right?
Absolutely, absolutely. That's why it's walking such a fine balance. And that's why we say
But
that,
at the same time, it's also a startup.
yes,
See,
yes.
I'm
But
putting all
then if you look at it
these
again,
dimensions.
let's look at it in the concept of alignment of economic, legal and accounting reality which I had mentioned. We are having the US headquartered, and that is another dimension which I am personally exploring, that in the context of startups particularly, when we look at FAR, functions performed and risks assumed, one of the most important functions in a startup is the ability to raise capital and bear the risks out of that capital. That is something which nobody acknowledges. There's no guidance in the OECD, it's untested. But personally, I believe that because it is a company established in the US, it has been able to get the funding.
Yes.
And that plays a critical role in the supply chain in the initial years.
Agreed.
That is a personal thought which I have.
No, that's correct.
I have not had a chance to develop that further, but conceptually I subscribe to that idea that you need to acknowledge the importance of the US as a capital provider. And therefore, just because there are 10,000 people in India but only 5 people in the US doesn't mean that because risks follow function, India should be the risk-bearing entity. US continues to bear the risk-bearing entity because in the startup phase, that is the key to the supply chain. If there is no funding in the US, if the US entity is not there, then the entire business collapses.
Or Singapore.
Sorry?
Now people are moving to Singapore also.
Yes.
Yeah,
Yes,
but
yes.
again, when you're raising the funds in the US,
Yes.
who is the face of raising the funds? It is the same CEO who is sitting in India, who
Absolutely.
is also a director
Absolutely.
in that and he's the one who is instrumental.
Correct.
So then where are the risks?
That's why the suggestion there is to ensure that the CEO is outside India.
Yeah.
He's not employed with India. Else it becomes extremely
Becomes very
difficult. Else the whole point of economic reality, legal reality and accounting reality, they are not falling in place. Else you have to call out the Indian entity as an equal partner in the supply chain.
In which case you can justify not booking a 15%.
Absolutely. But are you willing to take that chance? Are you willing to call out India as a risk-bearing service provider? Because during the time of losses, we want India to bear the share of the losses. But during time of profits, are we willing to share profits with India? That is a difficult question which startup founders are grappling with and investors are not comfortable. Because again, from an investor standpoint, because all these startup companies have dominant investors, and the investors are very clear, all the profit should come to the US because that is when they will be able to draw out their capital. All the IP should be based out of the US. It cannot be shared with India because if you share it, you have to share the profits also. Right? That's the sticky point today.
That's the logic which is being used. That all the IPs are in the US and therefore the profits are.
Profits should be there. But then that's where those principles are on one side and OECD's principles on risk follows function, they're colliding today. Yeah, thank you guys. Thank you for patient hearing and some interesting questions also.
Thank you, BharathLakshmi Narayana, sir. As a token of gratitude and respect, I request Chairman of Bangalore branch to hand over the appreciation token. Thank you for sharing your insights and professional experience to our members. Well, we can quickly break for lunch and reassemble at 2:30.